When you're watching the news, there are always a few topics that never go uncovered, some of them being weather, sports, unfortunately politics, the freaking stock exchange which no one seems to understand. There are a few people who make enough money to last a lifetime using the stock market, but how? If the stock market terrifies you and causes your brain to fart, you're not alone. According to a global survey done in 2014, 2 out of 3 adults are not financially literate. It's not your fault schools don't teach you this stuff, but it's pretty easy to pick up the basics. What is the stock exchange? And how does it work? The stock exchange is actually just a giant globally connected network and organized marketplace where every day a large sum of money is exchanged back and forth. In total, over $23 trillion was traded in 2019. More than the value of all goods and services of the entire world economy, which is absurd. However, it isn't Fortnite gift cards and Pokemon cards that are being exchanged on this marketplace, but mainly securities. No, not that security. Securities are right to assets. They are usually in the form of shares. Shares or stocks are basically tiny pieces of a company. When we say tiny pieces, we actually mean a lot. For instance, Apple is made up of over 16 billion shares. When you buy a stock, you're buying one or more of those pieces of a company. For the most part, you can only buy shares of public companies. While many large national companies are public, not all of them are. In fact, of the approximately 600,000 U.S. companies with at least 20 employees, less than 1% are public. So now the question stands. But why are shares traded at all? Well, first and foremost, the value of a share relates to the company behind it. If you visualize a pizza and think of it as the overall value of a company, the bigger the pizza, the bigger every piece is. If, for example, Facebook can significantly boost its revenues by implementing a new business model, the size of the company's pizza will also grow, and the value of its stock will rise as a result. This is, of course, fantastic news for shareholders. But what does this mean for Facebook? The company will raise funds by selling shares and use the proceeds to invest or expand its operations. Facebook, for example, has profited $16 billion from its Nasdaq listing. However, stock trading is often a game of chance. Nobody can predict which company will succeed and which will fail. Investors would back a company with a good reputation. A company with a bad reputation or a poor track record would have trouble selling its stock. Even a simple rumor may cause a share's demand to plummet quickly, regardless of the company's true value. Of course, the converse is also true if a significant number of people buy low-quality stocks. Because they see great potential in an idea, as a result, their worth will increase. New businesses, in particular, will benefit from this.